Welcome everyone. My name is Drew Coleman. I'm a financial advisor at the Next Level Planning Group. Welcome to our fifth session of our new series titled 10 for 10. Each one of these sessions is roughly 10 minutes long, with the objective to do a deep dive into one topic. Today's session will be on what influences bond prices, because it's more than just interest rates. Before we start, I've got a few disclosure slides to share with you all. So let's get into it. What influences bond prices? This is an interesting question because changes in price impact the return we all experience as investors. Rising prices are good for performance and falling prices are not so good for performance. And a bond's annual return is more than just its stated interest rate. Pays a stated interest rate, but that's not the only part of its return. It also can experiencing rising prices and falling prices. And it's that total package that describes how that bond performed in a year. It's the total return, it's the price change and the interest payment that make up that total return of that bond and that bond's performance for the year. And today we're going to describe those four big influencers. What are the four influencers of bond prices? Number one, it's changes in interest rates. Number two, it's market conditions and the demand for bonds. Number three is the credit worthiness of borrowers. And number four is time. And before we dive deeper in this conversation, I want to talk about one basic assumption that covers this. And that is, we're not going to talk about bonds that default. Yes, clearly, defaults will massively impact price. But for today's conversation, let's assume that bonds that are issued at par, which is $1,000, have an experience, and maybe it's a 5-year, a 10-year, a 30-year experience. But at the end of that time period, and when bonds mature, they pay out at par. And so let's just focus on those bonds and the price changes they experience through time that are influenced by changes in rates, market conditions, credit worthiness, and time. So let's get right into it. Changes in interest rate. This is the first big influencer of bond prices. Just as the daily moves of the stock market cannot be predicted, the daily moves of the bond market cannot be predicted. Interest rates move throughout the day, up and down. What we're looking at here is the 20-year history of the US Treasury rate. This is the 10-year US Treasury rate. What we see here is that, rates decline, rates increase, and also rates zig and zag. Rates are dynamic. They're constantly in motion, and those changing interest rates are impacting bond prices every single day. Now, bond prices and interest rates have an inverse relationship. As rates go down, bond prices go up. And as rates go up, bond prices go down. And this was the story of 2022. In 2022, the Bloomberg US Aggregate Bond Index dropped 13% due to the Federal Reserve's aggressive interest rate tightening policy to fight inflation. The Federal Reserve raised interest rates 4% over the course of roughly 8 months in their fight against inflation. And as the Federal Reserve rose rates, bond prices dropped. And as we saw last year, they dropped 13%. If we want to understand how sensitive bonds are to interest rates, we can look at a statistic known as duration. Duration provides us two measurements. The first thing is that it's an approximation of how fast you get your money back. So if you've made a payment to buy a bond in the form of coupon payments, how fast do you get your money back? And if that duration measurement is 3.5, it's saying you get your money back in about 3.5 years. Duration is also a measurement of the sensitivity to changes in interest rates. That 3.5, in the same example, would say if interest rates went up 1%, a bond or a bond fund would go down in price 3.5%. And the same would be true the other way. If interest rates came down 1%, Well, that sensitivity of that 3.5 duration would say that prices would rise by 3.5%. And the second influencer of bond prices is general market conditions. And so when stock markets are declining, traders and hedge funds are dumping their stocks, they might rush to lower risk assets such as bonds. And the surge of demand for bonds will result in rising prices for bonds and bond funds. On the flip side, investors can rotate out of bonds due to rising stock markets. There might be an element of FOMO and fear of missing out, as we're seeing this perfect market environment in which stocks are rising and investors are letting go and shedding their bond investments, their bond holdings, to buy stocks instead. And we saw it in 2021. It was the environment of Tina. Tina said, there is no alternative to stocks. Bond yields are very low. Many stocks had dividend yields higher than interest rates on bonds, and investors were dumping bonds to own stocks in that environment. So market conditions can have an absolute impact on the price of bond, and it's that supply and demand feature of bond holdings. The third big influencer is creditworthiness and the changing dynamic of creditworthiness of issuers. Bonds are debts that are typically issued and outstanding for many years, and the creditworthiness of borrowers doesn't remain static and in fact shifts through time. And the financial conditions of the companies that issued those debts might get stronger and might get weaker. And that changing creditworthiness of that company has a real impact on bond prices. Now, creditworthiness is given a letter grade by rating agencies. Moody's and Standard & Poor's are two of the biggest rating agencies for bonds. And when bonds are being issued, they'll take a look at that bond and they'll take a look at that company that's issuing that bond and assign it a letter grade. And that assignment of a letter grade is a measurement of the creditworthiness of that bond and the ability of that company to pay its debts. And so you can see here on this table that high quality bonds are given grades like AAA or AA. And these are investment grade bonds with very little risk or low risk. Whereas lower quality bonds issued by companies that have poor balance sheets and perhaps poor cash flow, they get lower ratings and they're in that junk area, that junk grade, and they're viewed as high risk. And rating agencies continue to monitor these bonds through time. It's just because a company and a bond has a rating at one particular moment of time at issuance doesn't mean that things stay the same. And bonds can get downgraded if through time during that total holding period of that bond, if a company's finances deteriorate, its balance sheet worsens, the credit agency would lower the rating of that bond, and that would send the bond price down. Alternatively, if that company's conditions improved and they got a stronger balance sheet with stronger cash flows, that might cause an upgrade in that rating. And that would be supportive of price and push that price upwards. And the overall letter grade places each bond in a risk category. And that risk category can be compared to US Treasuries, which are considered to be one of the safest investments in terms of getting your money back. US debt is viewed as very safe and is the benchmark relative to all other bond investments. And the difference in the yield between US debt and other debt of the same maturity is known as the yield spread. And looking at this chart, whoops, I went a little too far. Looking at this chart right here, we're seeing the yield spread of investment grade bonds relative to US Treasuries. What we're seeing here is 25 years of data in those yield spreads, and most of the spread ranges between 1% and 2%. But there are a few instances in which yields and that spread spiked. In 2008, it exceeded 6%, and in 2020, it exceeded 3%. And in these moments in 2008 and 2009, this was the time of the financial crisis. And companies that were previously being viewed as safe investments and high quality and likely to pay, when the financial crisis hit, the market got very worried. And there were concerns, and there were real concerns that companies wouldn't be able to pay. Companies that were previously viewed as being highly viable were all of a sudden being considered as perhaps at risk of default. And when that happened, spreads widened. And as spreads widened and increased and approached 6%, prices dropped. But we also saw that through time. And as we got out of 2008 and out of 2009 and moved into 2010, we saw the sense of, oh yeah, these companies will continue to exist. Better times prevailed, and the spreads came back in and narrowed. And at that time, prices rose. And so at one point, prices dropped when spreads widened, and then prices rose when spreads came in. And then you can see the same kind of inverse relationship with spreads and price relative to interest rates and bond prices too. And the same thing happened in the COVID pandemic. In the immediate time in which there was closure and people were being asked to stay home, there was real concern that companies could continue to exist. And we saw a widening of credit spreads, hurting prices, causing prices to drop. But then as we realized that things would be okay, spreads came in and prices rose again. We see this even more aggressively and even more severe in the high yield bond market. Typically, you can see prices are actually the spread, typically not less than 2.5%, but occasionally getting up to 7.5%. But in times of severe stress, like between 2001 through 2003, the spread exceeded 10%. It reached 20% in 2009, and then spiked to about 8.5% in 2020. And in these moments when the spreads spike like that, there's a real significant impact on prices. Prices drops. As the fear factor rises that these bonds may not be as strong as we thought they were, companies may not be able to pay, and there might be a default. But just as we see, the spreads widened, and then they narrowed. And so we see a major drop in the price, and then it's followed by a recovery and a rise in the price. In 2008, for example, we can see this is one of the most severe times in which spreads widened the most. The Bank of America U.S. High Yield Index reported a decline of 26.4%. So in that year, there's a massive decline in price, which led to that overall negative performance for 2008. And the final influencer of bonds is the aging of bonds. As time marches on and the maturity date gets closer and closer, there is a dynamic at play, which is called the pull to par. Par is simply the face value of the bond. And bonds are typically issued in denominations of $1,000. What we see here are 3 30-year bonds getting pulled to par. Now, the one in the middle, this blue line here in the middle, this is a 5% coupon bond in an environment in which the prevailing market rate is 5%. What we see here is that pull to par is like it's trading at 100% of par. It's trading at $1,000. And as time progresses and it moves towards year 30, that maturity date, it moves in a straight line and it stays at 100% of par. But then we can see the top line, the teal colored line. This is a 10% coupon bond in which the prevailing market rate is 5%. And this bond is trading at a major premium relative to the 5% coupon bond. It's trading at 180% of par. So it's trading at roughly $1,800. But the issuer of this bond doesn't owe $1,800. They owe par. They owe $1,000. They borrowed $1,000. They'll pay back $1,000. But this bond is being priced at this high level right now because it's offering a 10% coupon for the next 30 years when the prevailing rate is 5%. So it's trading at a nice premium relative to the market. But like I said before, at maturity, the issuer only owes par, not something greater than par. And so you're seeing this decline of price. The price approaches and goes down from 180% of par and makes its way downwards to par, which is $1,000. And then lastly, the bottom line, the dark navy blue line, represents a bond that's trading at 3% when the market value is at 5%. That's the prevailing rate of bonds is at 5%. And this is in a sense is where we are right now for bonds that got hit in 2002 when interest rates rose, and You've got this bond now that it has a 3% coupon, yet the market's at 5%. And that bond is trading at a discount, it's trading below par. But still at maturity, that bond will pay out par. It'll pay out $1,000. And so through time, that bonding, it recaptures its price. It recaptures the price that it lost. Because at the end of the day, the issuer isn't off the hook and has to pay less than par just because rates went up. It still owes $1,000. And so pull to par is the final influencer of bond prices, because at the end of the day, all these bonds have to pay back what they initially borrowed. And so let's recap. What are the four big influencers of bond prices? Well, it's changes in interest rates, it's market conditions and the demand for bonds, that's the supply and demand, it's the creditworthiness of borrowers, and it's time. So thank you for joining me. I hope you enjoyed this. I hope you learned a lot. We are now halfway through. This was the fifth session. We've got 5 more to go, and stay tuned for more. Bye.